Success Series. In our last video, we spoke about the Conceptual Framework for Financial Reporting 2018. It's part 1. Today is a continuation of that. If you have not watched the part 1, check the video description and watch the part 1 of the Conceptual Framework. Today we are going to move on with the part 2. And part 2 we are going to look at the 4 remaining chapters. That's chapter 5 to chapter 8. Chapter 5 will talk about recognition and derecognition. Chapter 6 will touch on measurement. Chapter 7 will dive into presentation and disclosure, whereas we'll end with chapter 8, which is the concepts of capital and capital maintenance. Now let's start with chapter 5. Let's start with chapter 5. Chapter 5 is about recognition and derecognition. Now, what is recognition? Recognition here basically means including an element of the financial statement in the financial statement. If you remember in the part 1 of the video, we looked at the various elements under chapter 4, which we spoke about assets, liabilities, equity, income, and expenses. Now, let's look at each of the recognition criteria of each of these elements. Now let's start with the assets. Now we can only include assets in our books only when there is a present economic resource controlled by the entity as a result of past event. This is gotten from the definition, so it must first meet the scope of the definition first, whereby there is a present economic resource, there is this essence of control, and then there is past event. Then the two addition to the definition is that it can be measured with sufficient reliability. It means we can reliably estimate a value for the asset. We can provide a value for it. We can provide an estimate for the asset. The last one, that there should be sufficient evidence of its existence, meaning that we should be certain that that particular element is in existence. Then we move on to recognition of liabilities. Now, a liability can only be recognized if a present obligation of the entity to transfer an economic resource is as a result of past events. This is also gotten from the definition for the liability from chapter 4. Now, in addition to the definition, we have that it can be measured with sufficient reliability, which implies that we can provide a value for it, an estimate for it. And we have the third one being that there should be sufficient evidence of its existence, meaning that we should be certain that it's not in existence. And we have the recognition of the income. Now here we will recognize income in our profit and loss when there is an increase in assets or decrease in liabilities, resulting in an increase in equity other than contributions from equity holders. This was also derived from chapter 4. The definition here was derived from chapter 4. In addition to this, we see that the increase can be what measured reliable, meaning we can provide an estimate for this increase. Now let's come to the fourth one, which is the recognition of expenses. Here, expenses are also recognized in profit and loss when there is a decrease in future economic benefits arising from a decrease in an asset or an increase in a liability. This is as well gotten from the Conceptual Framework, the chapter 4 of the Conceptual Framework, the definition of expenses. In addition to this definition, the expense can be measured reliably, meaning we can provide a value, an estimate for the expense. Now bear in mind, we do not have a recognition criteria for equity. We do not have a recognition criteria for equity. Now this has been fully detailed or explained in one of our videos. Check it out to have the reason why equity does not have a recognition criteria. Now let's move on. Now we are done with the recognition aspect and we are moving on to the second aspect of the same chapter 5, which is the derecognition. So derecognition, what does derecognition implies? Recognition here means that there is a removal of an element from the financial statement. Yeah, that's whereby we remove one of the elements from the financial. When does this mostly occur? It occurs in the case whereby that particular element does not meet its recognition criteria anymore. So we have some of the elements, we recognize them alright as meeting the recognition criteria, but along the line, they may no longer meet that particular recognition criteria. And when that happens, you need to recognize them from your books. You need to remove them from your books. Now, we're moving on to chapter 6, which is measurement. When we talk of measurement here, what does it imply? Measurement here, we are just talking of the amount to recognize your asset, your liability, or a piece of equity, income, or expense in your financial statement. So here, measurement is the amount to recognize your asset, your liability, your piece of equity, your income, or your expense. Here, under the conceptual framework, measurement has two bases. We have the historical cost basis, and then we have the current value basis. Let's start with the historical cost. The historical cost basis here tends to explain that measurement is based on transaction price at the date of the recognition of the element. So the historical cost is based on that you must trace the transaction price on which that particular asset was used at its recognition date, and that should be the measurement you are supposed to provide for that particular element. Now we move to the second one, which is a current value basis. It suggests or it proposes that you measure an element, or an element should be updated to reflect its current condition at the measurement date. So here it defines it measures the element updated to reflect the conditions at the measurement date. And here we have three major subtypes on the right. We have the fair value, we have the value in use, and then we have the current cost. Now what is fair value? Now fair value under the standard IFRS 30 fair value. Now fair value under the standard IFRS 13 fair value measurement will provide the definition for fair value as just a price that would be received to sell an asset or pay to transfer a liability in an orderly transaction between market participants at the measurement date. And this is normally what we term as the asset price. So it's a price that would be received to sell an asset or pay to transfer a liability in an orderly transaction between market participants at the measurement date. Then the next one, we have value in use. When we talk of value in use, what does it mean over here? Value is the net present value of the cash flow generated by an asset as it is currently used by the owner. So here you tend to find the net present value of the cash flows, that's the amount of money you tend to generate from that particular element, and you use that one as its cost. Then we have the last one, which is the current cost. The current cost basically explains or is defined as the cost that will be required to replace an asset in the current period. So we are just looking at the cost in which will require us to replace that particular element in the current period. Now moving on to chapter 5, which talks about presentation and disclosure. Presentation and disclosure. Now here, the main aim of presentation and disclosure is to provide an efficient communication to in financial statement. The main aim always is to provide an efficient communication to in the financial statement. How does this happen? It will only happen in a case whereby the following requirements are made. The first one is that we should focus on the objectives and principles of the presentation and disclosures and not the rules. Most of the times, entities tend to focus on the rules, neglecting the main focal point or the reasoning behind that particular statement or the presentation or the disclosure I'm making. So focus on analysis should be made based on the objectives and the principles of the presentation and not based on the rules. Now the second one is that you should group similar items and separate the similar items. Yeah, in grouping similar items, you are trying to say you need to aggregate all the similar items, give an aggregation of all the similar items. Whereas the items which are not similar, you have to make sure that they are distinct or you show a separation among them. And the third one is that you have to aggregate information, but do not provide unnecessary detail or the opposite, excessive aggregation to obscure the information. You need to aggregate information, alright. And here, aggregating information here should imply that you are not going to obscure that information that you have, but rather you aggregate them under a reasonable point of view. And in doing that as well, you should not also give unnecessary detail as well. Now let's come to the last chapter, chapter 8, which is the concepts of capital and capital maintenance. Now the conceptual framework explains two concepts of capital. We have the financial capital and then physical capital. Now let's look at the financial capital. Now the financial capital is geared towards the net assets of a business. So here we say that you are financially good over here. When your profit, you earn your profit only when the net asset that you have at the end of the period is greater than the amount of the net asset that you have at the beginning, and this should exclude contributions from and distributions to equity holders. And due to this, the financial capital maintenance can be measured either in the nominal monetary unit or the unit of the constant purchasing power. Now we have the second one, which is the physical capital. Now physical capital here is based on the productive capacity of the entity. It's based on the productive capacity of the entity, which is the unit of the output per day. And here we say that you can earn your profit only if the productive capacity increases during the period. So your productive capacity you have at the beginning increases over time during the period, after excluding any movement with equity holders, which is any contributions you receive and any distributions you make to the equity holders. Thank you.